Hey, good morning, everyone. Marty Mizora here, January 31st, 2020. So, folks, this morning I'm going to cover a lot of ground over a relatively short period of time, I hope, for what we're going to cover today. It's been a while since I've done one of these. I want to bring you up to date on the macro. I've been showing you the highlights each week and promised, once a month or so I'd come in with a video. So, I'm going to do that. Going to look at just the chart where I usually show the technicals for the S&P. Last time I told you it's been like watching paint dry as the market continues to just kind of meander higher. Little different dimension here with the recent sell-off. And then I'm going to share just a few of the new additions to my charts that trouble me file. And just kind of give you that feel for what we're thinking, why we're allocating your assets, you clients, the way we are currently, and what probabilities say about what's to happen going forward. So on the screen in front of you is our index, the PWA Macro Index, lowest score ever in terms of the index while it's been live. Not the lowest historically when we backtest, and you've seen this before, but this is updated as of today. So here we are with the 17. Back here, you can see when we rolled over to a 10, months before this big correction in the early 00s when the tech bubble burst. Actually, it was a shallow recession. Rolled over to a 36 quickly, but remember, these are back tests with lots of space in between. I'm not sure what the week-to-week scores would have been in here before we had the worst recession since the Great Depression. And as I remind you often, and clients in review meetings, before we ever turned red, I said, you may not like me for a while once we turn red, because history suggests that the data deteriorate and then the central banks and politicians get busy. And stock markets love nothing more in the near term than busy bees when it comes to central bankers and politicians trying to stimulate themselves into job security because their counselors who are objective and not afraid to tell them what they don't want to hear are telling them there's risk out there and we need to do something. The Fed is always going to guide in a very sanguine, if not optimistic way, because guidance is one of their tools, and they've decided that they have a third mandate. It used to be inflation, keeping it moderate, and keeping employment somewhat full, however you define that. Now they say that we also have to keep the expansion going, so we need to eliminate cycles. Impossible, and the more you try, the worse the down cycle ultimately is. And folks, I can say with a great deal of confidence, this time will be no different, and the longer they keep inflating it, the worse it's going to be when it comes down. Hence our very much more defensive posture than we've had the last 10 years. So, okay, and then the areas. I want to share with you the areas that are continuing to deteriorate. Um, Economic surprise index, don't need to show you that. That's still slightly positive to the US, but it's below the number that we would call it green. That went from green to yellow. Really, it's commodities that are just a mess. And of course, that makes perfect sense. Looking at the picture from Beijing and, of course, other parts of China, the epicenter supposedly for the coronavirus, it's a ghost town. Factories are shut down, will be into next month. Um, we're talking about the largest number of consumers on the planet really being hunkered down, and the numbers are concerning. We should hope and pray for everyone who's affected and infected by this because it's no doubt scary. And while it doesn't seem to be as deadly as, say, the SARS, it's deadly enough and it's sickening enough and it spreads fast enough to be a real concern for people, of course, first and foremost, but then for the global economy in a really big way when you look at flights canceling and so forth. So today's big drop, S&P down, 50 points, 1.6%, I think at the low. Dow must be down 500 plus points. That's very appropriate for a number of reasons. Number one, right? This has nothing to do, well, I should say the latest, this big jump to minus 17, that has something to do with the coronavirus because our very high frequency data is rolling over and commodities, copper, of course, is just falling like a rock. And this has something to do with it. But I want to make very clear, this was our trend before we knew anything about or before there was any incidence of the virus. And by the way, bonds have been trading higher. Gold has been trading higher. I think gold is our best asset class year to date. I looked at it day before yesterday and it was up 4.5% on the year. It was down yesterday, but it's up 0.5% today. So gold, the Japanese yen, the bonds again, and then the more conservative or more defensive sectors outperforming the more aggressive or cyclical sectors. I showed you that in my earnings report here earlier in the week. That says something about general conditions, which is confirmed by what our index says, or I should say, those things confirm what our index says. So my view has been that this kind of action is ultimately going to transpire at some point if conditions continue to deteriorate the way they have. Um, the coronavirus, of course, creates a externality that just happened to us real quickly. So what we should expect is days like today. I think the market was too sanguine day after day. We had a big up day yesterday, well, a big turnaround yesterday. 2 days before that, we had a nice up day. Um, those were curious to me. Yesterday, the World Health Organization said, this is a global emergency, but go ahead and travel. Well, that go ahead and travel was good for like a 300-point rally in the Dow. And of course, we were seeing that's all been taken back today. So this makes sense on a near-term basis. What also makes sense is because the Fed is very engaged, for one, central banks throughout the world pretty much are, that when the spread begins to slow, when the fatalities begin to slow, when it looks like maybe there's some light at the end of the tunnel, then there's no reason we shouldn't expect this market to come screaming back. That would be part and parcel to what we're seeing. And this whole action really that defies the fundamentals that I'm showing you is part and parcel to late stage cycles. And the one saving grace I can find, I don't know if I'll come to that chart in my talk this morning, is, and I've shown this to you before, that really share buybacks explain much of this big rally. $5 trillion has been spent by companies buying back their shares. And so that has a lot to do with this. Now, when you look at the chart of inflows to ETFs and to mutual funds, which I've shown you before, it's actually contracted a bit, particularly the last few years. So you could argue that there's a lot of money that has not participated, that this has been still the bull market that's been the most hated, and therefore we're going to get a bunch of participation. Well, that could actually keep this thing going throughout this year. Very well could. It also means that a lot of unsuspecting people, and this is what happens here, are getting sucked in near the top. Folks, this dip right here took back 11 years of gains. That's my concern. So I've been preaching this in client meetings. I've been preaching it here in if you're going to be our client, you're going to have to get comfortable with the idea of not catching this upside, or not all of it. Our new allocation definitely catches some of the upside, no doubt about it, but nothing like we did back in here. It just isn't going to happen with conditions looking like this. We're just not going to allow ourselves or our clients to go rushing off and chasing the herd, even though I could be telling you this story 2 years from now. As long as conditions look like this, we're just not going to do it. So just to give you just a little insight in model core portfolio, and many of you are 100% in that core, and that would be because you have nothing but qualified money, and we were able to move you to that mix with no tax consequences. Many of you also have, substantial embedded capital gains and no stomach for taking the tax hit and moving completely to our new core. So you know who you are, and we've done the best we can getting you to that mix. And then on top of everything else, and this is truly the icing on the cake, certainly on all portfolios that are large enough, which is most of them, but we have some grandkids accounts, that sort of thing. But where we could, we put the put protection underneath. So, and we put it at 10% below the spot where we rebalanced each portfolio. And of course, that's helping out today. Now, that really kicks in a big major sell off like this. And that's what provides a real floor for portfolios. So many of you, I've shown you how we score your portfolio. I've shown you the graph. It goes flat after a few percentage points down, which means you stop losing money. Always keep in mind, those are assumptions based on correlations and deltas and betas and all these measurements of how each position scores against the S&P 500. So it won't be exactly what we're illustrating, but it is absolutely and unequivocally meaningful protection. And again, well, I'm sure there are some of you out there who would love to just be catching every, you know, molecule of or inch or percentage or fraction of a percentage of every gain. Having done this for 35 years, lived through all of this, the 87 crash and so forth, felt it, experienced it, notated while I went, and then went back and studied the heck out of them and ones even before then. I do think this market could continue to melt higher. I do think it's completely left the fundamentals, and I do think we are in a bubble, particularly when it comes to the corporate debt market, which concerns me the most because that's what makes the next bear market another bad one. Okay, so I'm already going way beyond what I thought I would do. So be it. If you're still with me, this stuff is important to you and you find it somewhat interesting. So again, I'm going to skip the charts. Trust me, they look really bad when we're looking at um, commodities, copper's rolling over, raw industrial materials rolling over. The Baltic Dry Index, which tracks the cost of shipping bulk goods across the world's ocean, has been down for 9 weeks at a low that I haven't seen in a very long time. A lot of people are making a big deal out of this. I've been pretty silent on it because this is the season, December and into January, when that thing tends to fall. But it's fallen so far now that I think it is reflecting lack of activity on the global scene. So it's worth talking about. But it's been a negative in our macro index for quite some time. The one, actually two things that picked up. The Atlanta Fed GDP now shows a 2.75% current GDP reading. That thing is all over the place. At one point a few weeks ago, it was 0.5 or something. So it's volatile. I'll have to look again at what their measurement is. I think it's worth scoring in our index. To offset that, I also use the New York Fed's nowcast. It was actually down last week at 1.16. So they are either measuring things differently or they're looking at, one may be looking at current levels, the other may be looking at rate of change. It's rate of change that you really want to focus on, in my view. So those were two things that was one thing. The other thing was the chemical activity index actually is in the green, and it's been in the yellow or in the red for weeks and weeks. It looks good. It's broken its sideways trend and it's moving higher. Digging in a little bit, it's all chemicals related to residential construction materials, and that reflects a really strong housing market. That's what the data lately, except for existing home sales. That was one thing that kind of surprised. It was a little fly in the ointment there. But overall, the consumer remains healthy. The reason we're down 17 or 16.67 and not 36 like we were here is because the consumer is holding up nicely. If and when the consumer begins losing his or her jobs, this is going to fall rapidly, and that's the next recession, in my view. So, folks, in the meantime, there's huge risk under the surface in the corporate debt space. I don't know that there's any way out other than it imploding. And if the consumer jumps to the rescue to mitigate as much as it won't be the consumer, it'll be the government spending the consumer's money, bailing out companies that have no business being bailed out, and further zombifying the U.S. economy. And that would be companies that really shouldn't be kept alive. Japan is the expert at that, and we don't want to go there, but it's going to be very, very painful to keep from going there. So it's long, slow, nauseating pain or a big disruption. I'm hoping for the big disruption. Let companies fail, let them go into default, explain it away as best you can, and then move forward. And then lots and lots of opportunities we will be looking to exploit down here. Right now, again, we want to make money if the market continues to rise. We don't want to go down 50% if it falls. From there, because I'm taking way too much of your time, I'm going to jump over to my my charts that trouble me. And just basically, I just dumped these in here. So here's just the latest stuff. So percent of sectors that are at all-time high valuations, okay? Consumer discretionary was 76% of the companies in that space were at their all-time high valuation, say price to earnings ratio, meaning they were expensive. During the tech bubble, 44% during the housing bubble, 99% today. Consumer staples, 96%. They were 57 and 43 respectively, tech bubble and housing bubble. Utilities, 100%, right? And we like these things, by the way, staples and utilities, because they're so darn defensive. The fact that they're trading so high should absolutely tell you something about conditions and where money is rotating to. Healthcare. Healthcare looks still pretty attractive relative to at least the tech bubble. Tech is right there where it was before. Communication services, your Facebooks, it's interesting what throws into that sector, but of course it's also your Verizons, AT&Ts, and so forth, and then your smaller component players. Expensive materials, expensive energy. It's been a tough place to be. Industrials, really expensive. REITs, which we like because of the timing. It's not a huge position, but it's enough there right now. And then financials look okay. This is my own. This is the S&P index, right, versus the percent of members that are trading above their 200-day moving average. So this is a breadth indicator. Here it is versus the 50-day moving average. Now, I don't have this loaded up, but when you look back historically, this tends to roll over, as does the one I just showed you, prior to big rollovers in the market. The S&P 500, the S&P 500 equal weight index, right? So this tells you that concentration, more concentration in the top 5 issues than we had in 1999. It's better when this outperforms. This says it's across the board gains. This says it's very concentrated. That's a dangerous sign for the market. Global debt in the trillions. 1999, there was about 80 trillion. It has tripled, 280 trillion, and then there's a little more projected right there, of global debt. That's a problem. Technical factors, economic fundamentals, forget about it. This particular chart suggests, of course, it's correlation, not always causation, but boy. The blue line is the total assets in the Fed, the European Central Bank, and the Bank of Japan. So this is basically the offsetting of the cash that they have dumped into their respective economies, meaning the bonds and the mortgage-backed securities they put on their own balance sheet. You see how the market loves, growing Fed balance sheets because it throws liquidity in the marketplace. Many are in the camp, and I'm in the camp, that says that big rally from October to now has a lot to do with the Fed jumping in and starting to print on a regular basis, 60 billion a month plus a bunch more overnight, half a trillion the last couple of months of the year. Markets saw that as stimulus, easy Fed. They didn't really see it for what it is, or traders didn't, as really the Fed desperately trying to keep the financial plumbing of the country flowing. I ran this on the blog, copper price. Believe it or not, this is worse today. So you can see how copper kind of reflects the global economy. And here is a 6-month chart. The purple line is the S&P 500. If that's going to catch down, it's got a long ways to fall. And then, folks, I think I'll close with this one on the charts that trouble me. I have dozens and dozens, but this is a look at basically junk debt or risky debt. Speculative grade companies have almost 1.2 trillion of debt maturing between 2020 and 2024. That's 14% from the prior year. That's concerning. And this, I think, speaks to why the Fed and other central banks are so desperate to keep this train running. That stuff comes due amid credit rating downgrades because the economy is slowing, or amid higher interest rates. And if you didn't read it, read my blog from day before yesterday, where I posed my own question to the Fed, why they can't raise interest rates. This really speaks to that. They've really got themselves boxed into a corner. If they can't keep the economy going, it rolls over, credit ratings get downgraded, the junk debt space implodes, as does the lower end of the investment grade debt space, triple B, and that's hugely problematic for the economy, make no bones about it. And it's also happening in the private equity space, which is on fire, like I couldn't imagine. Meaning it's just a lot of money flowing into that space again this year. So structural issues, I know the Fed is exceedingly aware of it. They can't be looking at the data and not feeling what we're feeling. And that explains why $500 billion has been printed the last 2 or 3 months of last year. Now they'll say, no, it's because of the repo. Well, why is the repo blowing out? And rates are low. They're talking about capping treasury yields. I'll probably harp on that at some point when I have a moment. Capping treasury yields basically just eliminates any market pricing or any instruction as to where assets should be flowing, and it just keeps the bubble going longer and longer. So folks, I apologize for being so doggone dire sounding, but I just want you to know, and I'm really speaking to clients, what's behind us really kind of changing tact, buying options protection, these kinds of things within your portfolios. If we saw all this, did all our work, had all our data and our indexes, and did not do what we're doing, then we are absolutely not fulfilling our duty to you or our responsibility to you. Okay, so let's just look at this real quick. For those of you who like this, I apologize. There just really hasn't been a lot to talk about. Virtually nothing has changed in the look. Upward sloping wedge patterns, as I've preached forever, are very bearish. We have those before just about every major, small or large peak in the market. We've had quite the extension of one here. We had this trend line get broken and then never got penetrated, even though the market kept melting higher. Have a new trend line here, broken with force. When we came down through this one, you may recall right here, I said, this is an objective short. Everything was rolling over, but don't short it because you're going to get a tweet or an announcement that phase one is on, and that's exactly what happened. Well, phase one is done. It was lofty to begin with, 200 billion over 2 years, more than they've ever bought from us. With what's going on in the Chinese economy now, particularly with the virus and everything, that's utterly impossible. Let's say it were possible. What does that do to the surrounding, countries or the trading partners of China, who are also trading partners of ours, if suddenly they pull all of that, capital and allocate it, or cash, if you will, and allocate it only to U.S. goods and services? Believe it or not, that's that kind of concentration, that kind of manipulation of the market and the economy is going to have global implications, because it's going to hit other important economies quite hard who do a lot of business with China and who also do a lot of business with us. But anyway, beyond all that, it's going to be interesting to see how the sides deal with the fact that China is not going to make good on that phase one deal. So the idea that they could go to a phase two when the phase one isn't doable, particularly under present circumstances, is just more stress for the market. So my point here is, I don't know that there's going to be any legitimate, China news other than containment of the virus that'll have this come screaming back into new all-time highs. So folks, this is just still not a good technical look. The momentum indicator, the MACD, is continues to have a negative divergence. Not the RSI. I took those lines out, so that resolved higher. We don't need to go there now, other than just the level. This is a sell signal. They're breaking down below this trend. You should see, a technician would be telling you, look for 3150 as support, maybe 3200, then 3150. You break down below there, and then we're at 3,000. You break down here, and then we're going to have, a whale of a bear market. That may be inevitable. That's what conditions are beginning to point to. But it doesn't have to be this year. It doesn't have to be, this month. Could be next year. Could be sometime. As long as the data, and I'll close on this, continue to show us what I just showed you, and that's just the tip of the iceberg, folks. We have to remain careful and protect against a major, major bear market. We will take some losses, but we want to take modest losses, just like we want to capture the bulk of every big bull market. Going forward, we want to miss the bulk of every big bear market and then take full opportunity toward the bottom. That's going to come. Let me say it again. I don't know that it's going to be a 2020 phenomenon. We have an election. You have the Japanese Olympics this summer. You have the Chinese 100th anniversary of the Communist Party next year. If they can delay the pain with money printing, tax cuts, stimulus, huge budget imbalances, huge inflated central bank balance sheets, they won't care. They will push off to tomorrow under the circumstances as much as they possibly can. When that tomorrow finally hits us, we better be prepared. But I can make a case, and I can understand why people are probably going to rush into this thing when we get good news on the virus, because we have so much incentive not to let the next recession happen. It's just the risk reward just doesn't make sense. So I will stop rambling there, I promise. Have a wonderful weekend. After tomorrow, I'm going to go silent. My youngest son and I are going to be backpacking the Mojave Desert, of all places. So we're both really jazzed about it. It'd be a good chance to get away and have some quiet. I will have a method of connection. So you'll be in very good hands back here with Jeanette, Nick, and Gladys, and I will be communicating with them periodically. So should be back the following weekend, next weekend, and then I'll probably blow up your email inbox with my pent up need to communicate with you. Have a wonderful weekend and a wonderful week next week. Talk to you again soon. Bye bye.